Welcome to the next episode of Debt Talks, a series by the Private Debt Initiative of the Institute for Neo-Economic Thinking. I'm Moritz Schularick and a fellow of INET. Today we have three outstanding guests to discuss a big idea and to discuss whether its time has come. Do we need debt cancellation? Do we need a debt jubilee? Biblical references are often made that moral obligation of creditors there is to forgive debts, but there's also macroeconomic elements and macroeconomic thought that has gone recently into that. So straight from ancient times to today, many new papers and research looks at the potential macroeconomic effects of debt relief. I'm thinking of a recent paper by Adrian Auclair and others. What we want to do today is to talk about policy proposals for student debt relief, but also look more broadly at household and corporate debt, study the situation, discuss the pros and cons of large-scale debt relief in the economy, and proposals that are on the table for the new U.S. administration. The three outstanding guests, I mentioned them, and I'm going to introduce them briefly, and then ask each of them for their view and a quick take on the situation, and we go straight into the discussion of the issue. Let me start with Sebnem Kalemli-Ozcan. She's a professor of economics at the University of Maryland, and I can really say one of the most influential and well-published scholars in this field. We also have Astra Taylor, documentary filmmaker and author, and the founder of the Debt Collective, the Union for Debtors, and in CNET, the director of the film, the documentary What is Democracy, that I think probably available to stream online. Last but not least, we have Richard Wake, who is not only on the board of INET and the founding father of the Private Debt Initiative at INET, but he used to be a banker. He ran the largest credit card company in the country and has written a couple of great books on financial crises, currently the acting banking commissioner of Pennsylvania. As I said, we'll start with a round of introductory statements and then move on to the discussion. And to keep it lively, I will weave in the Q&A from the audience, so feel free to use your tool and ask questions. I will mix them into the overall discussion. So let's get started. Sebnem, starting with you, thanks for being here. Debt relief is a big idea. Is it an idea whose time has come? How do you think about it as one of the leading economists on these questions?
So thank you, Maurice, very much. It's a pleasure to be here with these distinguished guests. Let me start, before answering that question, how do we think about debt as economists? Because I think in order to answer that question, we should really understand why we have debt at the first place. So the way economists think about this is that you borrow, which means you accumulate debt because you want to finance an investment, right? So if you're a student, this means you're financing your educational investment. If you're a firm, this means you're financing your firm's investment. If you're a household, that means you're financing also an investment because that's your household wealth. And the idea here is you are going to pay it off with future growth, right? That's how the economists think about it. So economists think about debt as a glue that sticks today's transaction to tomorrow's transaction, today's goal to tomorrow's growth. So in that sense, it is hard for economists to think a world without debt, without borrowing. Saving and borrowing, just two sides of the same coin. If you save, you borrow, right? Some agents are going to be saving, some agents are going to be borrowing, and that's going to be a fundamental thing in any economy. Now, of course, having said that, if there's too much debt, then you get out of this equation where you are financing something profitable that will give you growth in the future so you can pay back your debt, right? If you have too much debt, too much leverage, then you do come to a point that you won't be able to pay back. And then that brings us to this question that, what should we do about it? And here again, the way the economists think about this is restructuring, right? You restructure that debt because at the end of the day, there is an investor on the other side of this equation. Somebody did lend you this money. And that somebody or that agent is also connected to the other sections of the economy. So this can be easily a dominoes type of story, starting with an action on certain group of agents by forgiving their debt. So that's why we think as a restructuring of that come to an unsustainable level when they are at a level that it is clear to all parties they cannot be paid back at those current initial conditions of contract. Then, of course, we think about restructuring, and you have done a lot of work on that. So I would like to open with that because no matter what we are talking about, countries' debt, student debt, household debt, or corporate debt, I mean, actually, that's something I know a lot about. We have to think about, how we come to this point. Or should we be thinking about restructurings and why these agents are borrowing at the first place, right? Because if you think about, for example, student debt, they are financing education, right? And that means if you are thinking about that problem, a solution to that problem that is long-term, you have to think about education policy at the same time. So most of the time when we go to the initial reasons of why there is so much debt, we have to think about structural policies. So for economists, it will be very hard to think about a single policy of debt restructuring or forgiveness without the policies that will help the cause of the problem. Let me just stop here with a broad opening, and then maybe I will pick up in details on some of these points.
Fantastic. Thanks so much, Sebnem. Astra, it's great to have you on this. You're an author, you're a filmmaker, and you founded a union, the Debt Collective. Maybe tell us a little bit about your motivation and what you observe on the ground these days.
Yeah, so I want to echo the thanks for having me and for inviting me into this discussion. And I think my comments pick up nicely on this, right? The question is one of, well, why are people going into so much debt? What are the underlying policies? So in the United States, the lack of free public education is driving people to borrow to debt finance their education. The lack of national health insurance system is creating a crisis of medical debt. Medical debt is one of the leading causes of bankruptcy in this country. In Canada, people are not suffering from medical debt because there's a national healthcare service. So I think these bigger policy questions are really important. So yes, I co-founded something called the Debt Collective, which is a union for debtors. The idea is that there's an imbalance between the power of debtors and the power of creditors in our society. We've seen debt explode. We're at record levels of personal debt. It was a crisis before COVID crashed the economy. It's absolutely urgent right now because what happens when people lose their jobs and lose their income and also lose the limited benefits that the government was providing to sort of make ends meet. So we've actually been in a kind of interesting space over the last few months where people were actually, because there was $600 a week of unemployment benefits coming to people were actually paying down their debts and actually getting their heads a bit above water. But we know that those policies are expiring and different pauses and moratoria. And for example, student loan collections are coming to an end. So December 31st, the pause on student debt collections will end. 33 million people will suddenly have a bill come due that they haven't been paying during these last few months. So the Debt Collective, the Debt Collective is a union for debtors. The idea is that we talk about our economy as one shaped by financialization. We talk about neoliberalism. Our insight, I think, is that this form of organizing the economy is experienced on the ground as indebtedness, right? In its most basic way, what the age of financialization is experienced for millions of people as the age of debt. So easy access to credit has covered up growing inequality. It sort of covered up stagnating wages. People have been forced to debt finance and individually debt finance what we believe should be public goods, right? So you're debt financing your education, you're debt financing your healthcare, and so on. And this has reached a crisis point. So 100%, I believe that we need a debt jubilee. We actually recently published, just in the last, it came out in October, a manifesto, Can't Pay, Won't Pay, the case for economic disobedience and debt abolition. It talks about all kinds of debt, from personal debt to actually municipal finance to sovereign debt crises. And the book is a provocation, and we're building on history. As you said, the call for a debt jubilee is ancient. It is a moral cry. It's a cry of people who, can't make ends meet, but it's also, there's an economic argument for it because debts that can't be paid won't be paid. And so there are arguments that it's better for everyone to face this fact, restructure debts, forgive the debts that can be forgiven, and figure out how to solve the policy problems that are driving this. So what can we do? I just want to quickly say that I think we're in an extremely interesting moment because Joe Biden is president-elect, and there is increasing awareness, thanks to the work of the Debt Collective, that he has the power to cancel federal student loans, which is the vast majority of student loans, on day one of his administration. So the Debt Collective launched a student debt strike in 2015 with students of a predatory for-profit college. Through various legal strategies, we have won from the Department of Education over $1 billion of debt relief for students who were lied to by predatory for-profit colleges. Our legal work essentially then started exploring, well, how could the student debt crisis actually be addressed? Is a student loan jubilee actually possible? So what we found out is that in 1965, 1965 Congress already granted the Department of Education what's called Compromise and Settlement Authority, the authority to erase federal student loans. So this is power that the executive branch already has. So this is something that that a Biden administration can do, even if they don't have the Senate, even if Democrats don't control the Senate. And there are lots of arguments for why this should happen. It's an economic stimulus. All that money going to pay off student loans would then be used to buy goods and services, help people stay afloat. There's lots of empirical evidence it would close the racial wealth gap. There's arguments about just how student loan cancellation helps make individuals more risk-taking. They become more entrepreneurial. They move. Their incomes actually go up substantially once they're freed from this debt. There's all sorts of arguments. I also think there's a strong moral argument. I think this is student debt shouldn't exist. People shouldn't go into debt for an education to begin with. But the important thing is, this is something he has the power to do, and it's on the table, being debated very intensely all over the internet as we speak. So a debt jubilee is not only necessary, it may very well happen in late January. We are actually launching a campaign aimed at the first 100 days of the new Biden administration, saying student debt cancellation needs to go, and you have the power to do it, and to not cancel this debt, especially during the pandemic that we're in, is actually an abuse of power.
Great, thank you, Astra. Moving on to lots of things to discuss later on, but first let me move on to Richard. Richard, such a pleasure to have you here. You have been preoccupied with the size of the debt burden and it being a millstone around the neck of the economy for quite a while. I mentioned you also ran a big credit card operation. So how do you think about these things? Why do people get into so much debt, and what should we do about it?
Moritz, I really appreciate being included in this panel, and thanks to my esteemed co-panelists, and especially to INET for enabling this. Total debt, including both private sector and public debt, has increased massively globally. To give you a sense, since 1970, for the world's largest countries, representing, let's say, 65% of global GDP, it has gone from 90% of GDP to 260% of GDP, roughly a tripling, a fact that really hadn't garnered nearly the attention it deserves. But the growth of debt in excess of GDP is not an accident. It's unfortunately the norm because it's built into the system. It takes debt to grow, therefore debt grows at a pace higher than GDP. And, it brings about a paradox. As this growth brings higher levels of debt, especially high private sector debt, it begins to stifle growth. Even with today's low rates, which everyone has commented on, the household debt service ratio is up 40% since the high growth 1950s and 1960s. This high debt also exacerbates inequality. Since 1989, which we know courtesy of the Fed's SCF, the debt to income ratio of the bottom 60% of the US, these are the middle and low income, these are working Americans. The debt for those folks is up 121% relative to their income. For the top 10%, it's up a mere 12% or 1/10. So the burden of this debt growth has gone clearly onto the middle class and to the less advantaged. High debt now burdens, as my co-panelists have pointed out, high debt now burdens millions of households and businesses, and families with high debt are far able to do the things we've talked about: pay for their kids' college, build additions to their home, buy new appliances, start new businesses, the very things we need to power the economy forward. Likewise, small businesses that carry too much debt are far less likely to expand, add branches, add product lines, invest in R&D. But reducing debt to GDP is very, very difficult and almost never happens on its own. Since World War II, none of the top 10 economies in the world have seen even a 10% reduction in public and private debt together. Obviously, it's been the very opposite. So we need overt forms of what we might call debt jubilee. Astra's mentioned one. And by the way, debt jubilee goes by a lot of terms: debt restructuring, debt amnesty, debt forgiveness. They all kind of are in the same category from my perspective. We need it, or debt to GDP ratio will just keep getting higher and the consequences will keep getting worse. But we need to be thoughtful, because there are broad sections of the US population that resent and object to debt amnesty if it's done on an unfair or indiscriminate basis. And that's a political reality we have to think about. So we've tried to put together ideas that provide jubilee but address this issue of fairness. For example, allowing student debt forgiveness, but only if tied to a certain amount of community service, or allowing home mortgages to be written down to fair market value, but only if the owner cedes a portion of that gain on a future sale of that home to the lender, and only if the lender is also given time to absorb the loss. We recommend 30-year amortization of that loss. Or giving health amnesty or amnesty on healthcare debt, but only on a means-tested basis. Now, you ask who pays for this. In many cases, the would be paid for by the government, but in our view, government still has ample capacity for select debt amnesty programs. In other cases, we advocate that the private sector absorb the loss, but only if we give the private sector ample time to deal with that loss, such as the 30-year loss amortization proposed for the mortgage write-down. Now, the most important and final point I make is that these programs could bring relief to millions of working Americans and help the economy. In fact, giving households and small businesses debt relief would be an extraordinary boost to the economy, since it would free money now being used for interest and principal payments to be put instead towards investing and spending. Debt forgiveness translates directly into economic renewal and resurgence. Thanks.
Thanks, Richard. Thanks to all of you. Let me follow up with a question that already weaves in also a question from the audience that we had here from Hilma Schaman. So if we need debt to grow for investment or for people to buy houses or get along, but when we cancel all debts now, will the creditors come back? Will we have as wide open debt markets in the future if we now do a debt restructuring, a debt policy? So is there, in short, is there a risk that policies now change the playing field in the future? Something for all of you, whoever wants to come in, please.
That gets routinely cited as an objection. And as far back in history as you go, you find there's an objection. If there was debt repudiation by the states in the United States in the 1830s, as an example. And European investors, primarily wealthy Londoners, are saying, if you do this, we'll never invest in another, U.S. security. But they always do come back. So I take that with a grain of salt. But I also think that it's imperative that you design a system that creates time and fairness, so that that's the essence of our mortgage proposal. We let the banks and other, the GSEs write it down to fair market value. We don't make them take the accounting loss immediately. We let them spread it over 30 years. They can take the tax benefit and they get the upside on a future sale. So you create something that has some reasonableness to it, that accommodates the needs of the various parties, as opposed to just blanket wiping out of debt.
I mean, but I think there's a question about which creditors we want to come back, right? I mean, I think this point that, you can impose limits on usury and people will still lend and borrow and there will still be business. But I mean, do we want, for example, payday lenders to exist? So if we wipe out the debts owed to payday lenders and those businesses go under, I don't think that would be a bad thing for society. I think student debt, again, the creditor there is the federal government. And I think there's a real question about whether the federal government should be in the business of lending and also substantially profiting off of student loans when there are other ways to finance public education, because it's a public good. And I think we're seeing in the COVID crisis that the only sustainable source of revenue for an education system is public financing, because we're seeing not only that tuition is unstable if students can't attend or feel they're not getting the full value of what they're paying for, but then also these other mechanisms of raising revenue like sports are also risky. So I think we have to sort of look at each thing one by one and be like, well, hold on, what area of the economy are we talking about? Should we be debt financing things? What actors actually do we want to put out of business? And then how do we create conditions to have, what we might call socially productive credit that actually does this thing that we say we want it to do, which is expand the boundaries of the present and build, a richer future, and rich in all the multifaceted aspects of that term, not just higher GDP.
Let me add to this that there's an important difference here in terms of creditors coming back if we are talking about a country's debt versus some other sectors like students or firms in a domestic setting, right? I mean, in fact, most of this research is for countries, for sovereign debt. And yes, they do come back, as Richard said, but of course, at what price? I mean, again, the way economists think about this is always we have to think the quantity and the price together. And we do know very well, thanks to actually a lot of research from Moritz on this, from the historical data, that countries that defaulted or that did some sort of restructuring, they do borrow at higher premiums. And one of the reasons, of course, why U.S. government can borrow at such a low rate is because it's assumed that U.S. government has no default risk. So in that sense, I think it's very different when we think about countries' debt and other debt. And going back to Astra's points of, who is the creditor point. But I fully agree, with Richard, that this has to be done in a fair way, and really a lot of thought has to be put in how we deal with losses. And this is very, obvious in the corporate debt. So corporate debt actually hinders investment. So there's something called corporate debt overhang. And we saw this in live motion after the 2009-10 crisis in Europe. European firms got into that crisis with a lot of corporate debt. This was different actually than the US case. US entered that crisis with a lot of household debt. European countries entered that crisis with a lot of corporate debt. And then what happened is, and then that debt is mostly was owed to banks. And if you look at the policy action by ECB during those years, 2010 and 11, is really about how do banks will absorb these losses, because clearly corporates won't be able to pay back. And we want to somehow restructure this debt because investment is not going to pick up as long as there is this debt overhang problem. And even with all those policies that thought very carefully, in terms of non-performing loans to the banking sector, which of course threaten the financial stability. And this has to be thought out very carefully. The problem persists, right? I mean, the sluggish recovery and slow investment pickup after that crisis in Europe basically was visible just before COVID. It almost take a decade. So in that sense, it is extremely important. And I think in terms of kind of economic growth and investment, the big dragger is going to be the corporate debt. But again, when we think about restructuring these things, and if it is mostly owed to banks, how the losses are going to be taken care of, we have to think about financial stability issues and all that. And again, going back to why corporates borrow that much at the first place. My research actually showed that the corporate debt boom from 2000 to 2008-9 in Europe is because of the low interest rates. And the low interest rate actually was part of the European integration process. I mean, it wasn't a part of the, a deliberate, action on the monetary policy side. It's just that, as of 1999, 2000, all these countries joined Euro. That means they have joined under one single central bank and monetary policy. And suddenly all these firms can borrow at much lower rates. You have an Italian firm that can borrow as cheap as a German firm. And that led to this huge corporate leverage and corporate debt boom, which of course during the bust hold back investment over a decade. So again, but it goes back to the original question, right? I mean, so should we have put in place other policies that, combined with these type of low interest rate that will prevent corporates to increase their leverage this much, especially small, medium enterprises? Because these guys are not going to be diversified, they are going to be bank dependent, and clearly the incentive is going to borrow. I mean, if interest rates are low and you are in an economy that is booming, of course you are going to borrow, and that's the optimal thing to do. So how should we think about then the financial regulation on these corporates, especially small firms, because we just cannot tell them not to borrow, and that's how the small firms grow, and small firms are actually the engine of growth. So we do want them to borrow. It's just that, how do we do it that they don't, go above and beyond in terms of leverage?
Thank you, Sebnem. Maybe let's stick with this point of the difference between household and corporate debt and student debt for a second. Also have a question here from Oscar, for example, saying sometimes corporate debt is different. CEOs like to use leverage to boost returns, whereas to the student loan, sort of on the household side, it's much more difficult to raise equity. At the same time, for the corporate side, we have a restructuring mechanism in law. For households, it's much more complicated. Astra, how do you think about this? Both from a policy perspective, I think we've kind of done a lot also on the corporate lending side to stabilize these markets. Would you agree that the corporate sector this time in COVID times is the more problematic side, or would you still say the policy focus has to be on the household sector?
I mean, I think we have to do both at once, right? And I'm not an expert on corporate debt, but it does seem to me that part of what's precipitated this crisis is corporations were over leveraged, taking advantage of very low interest rates. And the question is always well, what are they borrowing for? What are they taking on debt for? And if it's really to invest and build and create jobs and create prosperity, that's one thing. But if it's just to, pay out extra dividends to shareholders, and it creates ultimately more systemic risk in the economy, that's a bad thing, which I guess brings me to my point that we worry a lot about moral hazard and debtors and distinguishing between worthy and unworthy individual debtors. And so I think part of what we're trying to do at the Debt Collective is disrupt that script, and to say, well, hold on, let's look at the people who have real power and the institutions that have real power in these dynamics. I mean, I'm not that worried about the banks, right? I mean, the banks have profited enormously. The financial sector is absolutely enormous and jacked up on profit, and raking in fees and interest. And so, I think we have to rebalance again and asking these institutions to take a loss is right. I mean, there's a reason that the chant at Occupy Wall Street was, banks got bailed out and we got sold out. There's often a double standard where debt relief is concerned. So I think we worry too much, in my opinion, about the questions of fairness and debtors, and that's because we're stuck in an old paradigm thinking about it. So to the issue, for example, of sort of figuring out how to distribute student debt relief, I think there's strong moral arguments for wiping it all away. I mean, we have something in this country called public service loan forgiveness, where you work for X number of years for a nonprofit or for the government, and you're supposed to have your loans erased. And the thing is that the bureaucracy is broken. So something like 2% of applications have been approved. So people live their whole lives, they go to school, and they get specific jobs. And at the end of it, 98% of people who have applied for this are just basically shit out of luck, right? I mean, so I'm worried about creating new mechanisms that reproduce this problem and this kind of confusion when we know that the student lending program is just it's not a vital organ. We can figure out other ways to run the system much more smoothly and with benefits that flow to debtors and to the broader community if we just think bigger and go bolder in our approach.
Thank you. Richard, you want to jump in, or otherwise I would tempt you to.
Yeah, I mean, there's about the same amount of corporate debt as household debt in the United States. So, in terms of the economy, both, have equal importance in my view. The mechanisms for dealing with debt restructuring are far more advanced for large corporations as compared to individuals. And part of this really stems from a different attitude about debt for corporations versus individuals. Debt on the corporate side is viewed as a contract. But as the late, great David Graeber pointed out, I think very beautifully, debt on the household side is viewed through a more moral context. It's immoral to not pay. It's not immoral for a business to restructure its debt with its lenders, but for some reason, it's immoral for a household to restructure their debt. So I think there's a lot of room for improvement in the bankruptcy process. I think the bankruptcy laws for households these days are more oriented towards punishment, frankly, than remediating. There's been a lot of very thoughtful work on how debt restructuring could occur that leaves the household and the car intact at the new current market value and really gives the household a better chance to succeed going forward. So I kind of lump very small businesses in with individuals in my thinking, because I think very small businesses approach debt the same way and get treated a lot more like a household than a large corporation is treated.
Let me just add something here, Morris, if we have some time, because you did ask about this COVID. I have a paper actually that looks at the SME failures under COVID, small, medium enterprises. First of all, a small, medium enterprise in the United States is a corporate that employs less than 500 employees. In Europe, this is a corporate that employs less than 250 employees. Okay. Now, these firms are extremely important. The micro enterprises, like firms with less than 10 employees, like Richard said, maybe we think them like households, but 10 to 500, these are firms. They actually not only constitute 99% of the firms in the United States, they account over 50% employment and output. This is the crisis we are seeing because of the nature of the COVID shock that hits the service sector and all those sectors that are heavy in these SMEs. I mean, we saw all those unemployment figures, right? I mean, how they skyrocketed very quickly early in the crisis. And of course, this happens in other countries, not just in the United States. Now, those companies actually, it is not like the large corporations. They don't have that type of luxury. They just go and file Chapter 11, restructure and all that. And they are going through a process that is very complicated. Most of the time, they are liquidated. And they are very important for employment and growth. Very, very important. It's just that we keep forgetting about this because, we don't have easily available data on these guys. These are private firms, so they don't report their statement like listed firms do. But they are super important. They are over 70% of employment output in Europe and over 55% in the United States. So if we want to talk about saving jobs under COVID and, startup growth, we really have to we think about these. And this is exactly what the policy action was about, right? I mean, PPP program, all right, and then the other programs in Europe is really about somehow how can we save these firms. So we have to think about why these firms also borrowed a lot at the first place, right? Because clearly we are trying to do everything right now to save them. And this goes to my second point on this asymmetry between booms and busts. Good times, we never think about this. Nobody talks about this. You know, the economy is growing, everybody's borrowing, there's credit growth. Right. The bust comes, there's a crisis. Everything is not, everybody's talking about this issue. We have to think about this issue during the good times. And the way to do that is with macroprudential policy, right? And this applies to household debt too. So we start thinking about these things very late. And when it becomes impossible to pay back, and everybody is in trouble, and then firms firing people, you know, that's just too late to think about this problem. We really have to do a lot in terms of policies in order to rein this type of credit growth, both for households and firms during the good times. I think this is very important.
Well, thank you so much. Let me bring in a couple of questions that have we have a long list here of questions from the audience. Some of them center and focus on the question of political feasibility. The one question is, in whose interest is the current system operating? Who will be the forces against that? And do we really have is there really a chance to implement these new policies? And maybe we can even be a little bit more specific on what policies exactly I guess each of you has in mind as priorities. If you will, if you don't feel happy to comment on that, if you were running the debt policy of the new administration, what you would think, and who would be the people to convince that this is a good idea?
No, I'm
looking at you.
I'll take a stab. I'll reiterate. I think that fairness is a big part of it. So let's just take the mortgage idea that we put forward that we think would have been very helpful in 2009, 2010, so forth. We think you have to pay attention to all parties and do something where all parties have a chance of winning at least a little bit. That where you're not trying to advantage one at the expense of punishing the other, or you'll never get it through Congress. And so, in this particular instance, you had to do something where the banks and the GSEs were in agreement. And since I spent my career as a lender, as a bank CEO, I can tell you that if I have a type of loan on my books that's at risk, that I would welcome the opportunity to think of a way to deal with that problem. So that's why we've said, let's write down the loans to current market value, but let's let the banks spread the loss over 30 years. Let's let them have upside in the eventual sale. Let's let them take tax advantage. I think something like that has a chance. And if you can get all the parties to agree to something before you go to Congress and ask for the law, you have an excellent chance of getting something enacted. And I want to put this in a little bit of an interesting historical context. When we study Jubilee in ancient cultures, this was not all just altruism. There was an element of altruism, but you remember the kings were trying to punish the wealthy merchants. But one of the reasons a king would forgive debt is because the lending community around that king had gotten too wealthy and powerful. And the debt jubilee knocked their wealth down a peg or two or three. Or a king would be invading a city and he'd promise the citizens of that city that he would wipe out their debts if they take his side instead of their district. So then let's not be naive about what the elements of Jubilee were back in ancient cultures. And let's be sensitive to the needs of all parties involved, or we're not going to walk into Congress and get something done.
Yeah. I guess then I'll pick this up with student debt, since this is the fight that we're in now. And I think it's a battle that we're going to be focusing on very intensely, and that is gaining a lot of momentum and just public awareness. It relates actually, in terms of building sort of an unlikely coalition of who could be for such a thing, right? Something as radical as a student debt jubilee. I would say people who are invested in housing, right? People in the building trades, people who want to lend and see more mortgages, because there's lots of empirical data.
President?
Yeah, university presidents. There's lots of data that shows that this $1.7 trillion of student debt that people collectively hold is inhibiting household formation. People are delaying having families. They're not able to become homeowners the way that earlier generations were. So, in this sense, all of these different debts are connected. I think, again, because the lender in this case is the federal government, it's quite an interesting thing. I mean, there are private loan servicers. We're not talking about private student loans here because, again, this authority that the debt collective has been working on and that is now being embraced inside the Beltway, compromise and settlement, applies to the student loans the government holds. So I think then it's, in a way, what we're up against is people just invested in the status quo, people who, created the student loan system, who would rather see it continue as it is and maybe not face the full brokenness of the system. And then I think addressing these questions of fairness. I mean, I think fairness we have to have a public debate about what that means, right? Because there's, again, arguments that canceling all student debt would be an economic stimulus. It would have benefits for the community writ large. And of course, it's not the perfect policy. It's not, but it's something that the incoming administration can do without having to get without having to get Congress on board, without having to get Mitch McConnell to agree to this. And that is something that's very powerful. In that sense, I think it would have other political benefits, because I think it would show to the American people who are very cynical about their governments because they don't see policies that help everyday people, right? They would see a bold action that impacts not just 45 million student borrowers, but their families, that would help parents, who are indebted, trying to put their kids through school, that would make whole all of the millions of people who have some college degrees, but never weren't able to actually graduate because maybe they were working 2 or 3 jobs or facing insecurity, housing insecurity, all of these things. It would also be fair to those people graduating into this crisis, right, who are not able to immediately get a job and benefit from the degree that they worked so hard for. So I think, fairness is something we have to have a public discussion about the greater good here and focus less on the individual debtors. But again, this is something that is very feasible. And Elizabeth Warren and Chuck Schumer have made a Senate resolution in September that is now getting a lot more attention that basically said $50,000 of student debt cancellation across the board on day one using compromise and settlement authority, this authority the debt collective has been promoting.
Thank you. Sebnem, if you allow me, can I rephrase the question a little bit for you? What would you think would be the macroeconomic consequences of these programs if they were enacted?
So I'm not sure what would be the effect of the student debt forgiveness will be, because I didn't do any research on that. I will take Astra's word for it. Clearly, she's extremely knowledgeable in that area. But for the corporate debt, which is something I research a lot on, eliminating a corporate debt overhang is definitely something that will propel investment. So that we already know. It's not just the European crisis experiment. We go back to other crises, other financial crises in time. For US, unfortunately, we have to go back to the Great Depression, and then the data will be problematic. But we can look at many other countries, many emerging market financial crises, and somehow dealing with corporate debt, either in an official way, if you're a large corporation, or more kind of a restructuring liquidation way. I mean, like if you're a small SME, small medium enterprise, that is something good for investment. We already know that. But I want to come back to this question. So it will be good for investment, but I want to come back and answer this question with the light of COVID, because, I mean, unfortunately, right now, if we are going to come up with new policies, we have to think about COVID, right? And COVID is like, now we know that we will be moving into a new world. We are going to recover from this, of course, but there will be a lot of reallocation of resources across sectors. Some firms and sectors may never come back. And so this is an active, intense debate right now. And in terms of what we are doing during this COVID-19 crisis to help is actually to do more debt. This is what we are doing. This is what governments are doing. And this is the huge increase in debt to GDP. Richard made this point already. And the corporates too, right? All the programs right now, pretty much all the countries put together, either there's a direct cash transfer from government to the firms, or it goes through the banks. Most of the programs actually go through the banks. And if we just go back and look since April, each of these programs looks like, and you can look at an international perspective here, the programs that are like direct transfers, grants, and programs with some sort of government guarantee works better than you just do your standard bank loan, right? Because that's again going to run into these issues that banks are going to evaluate this sustainability of this loan and all. But if that's the case, then we should be seriously thinking about equity-like interventions, right? Equity-like injections. Why do we like equity more than debt? Because equity gives you the upside and you lose on the downside. That's why we like equity more than the debt. And if we are at a moment right now where we really want to come up with these new inventive policies, which seems like in every country, government is a big part of this, helping the, corporate sector, especially small firms with more debt, then maybe we should really think about these more equity-like interventions where, there's some sort of realizing returns on the upside. I mean, very early on, we had a proposal, which is part of my COVID and the firm failures papers. Actually, we proposed a negative tax. He said, look, this can easily be done. Why do we involve banks here? This can easily be done through the tax system. You just give a negative tax. This is a direct grant to firms, and you turn it into excess positive tax when we recover, so you claw back the profits, right? So that's an equity-like injection. You realize upside, you lose on the right side, which of course goes to this: how much credit risk should governments take, which is also part of, I believe, Astra's proposition for the student debt. But I do believe, thinking about these, how do we do more equity-like interventions, and how do we attack at the same time the original cause of the debt, right? Because if we eliminate everything right now, people are going to go and borrow again, right? And the solution to the saving the small firms is more debt right now, right? That's how we are trying to solve this problem. So we have to think them together. How kind of get to the green side from this crisis, and how make sure we are not going to have this huge accumulation of the debt going to the future, which is going to be extremely difficult. And going back to Richard's point, if you look at since Second World War, it is these numbers are amazing right now. So it's not going to be straightforward, but we have to think these policies together. But again, answering the macro question, for sure, for growth and investment, it is important to deal with the corporate debt, for sure.
Well, Sebnem, you actually addressed the question partly that I wanted to ask you next, and it also came up in the Q&A, and Oscar and others mentioned it. It looks like the solution to this crisis is going to be more debt. Why is it that debt is so popular and equity, even on the household side, sort of stronger risk-sharing agreements prove so unpopular? What is it that makes debt so attractive and the chosen financial instrument for a lot of these circumstances? Everyone, this is we're in the Institute of New Economic Thinking. We want to think big and think big ideas. What do you think is the potential for different contractual forms, and why might they have a hard time? What makes debt so attractive for many people?
Debt is so much more. Please go ahead.
No, you go first.
Oh, thank you. Debt is so much more easy, so much easier politically, that it tends to always be the default solution. There's a lot of work that was done on the Great Depression and all the FDR alphabet soup of programs. And if you study it, you'll notice that the real revolution during that period was in new federal credit programs, because they were things you could do without spending government money. So, that there's always going to be that bias in the system. And, just gutting it up and spending through these $1,200 checks or forgiving the student debt or things like that are always more difficult politically. And that will remain true. And I think, it's also as it relates to the concept of equity, it's easier to do that with a corporation, much easier to do that with a corporation, and very, very difficult, near impossible to do that with individuals. And anytime, back in ancient times, there were, equity-like forms because you gave your children to the borrowers, collateral or things like that. We could never return to those days.
Yeah, indentures behind us, we hope. Building on that, I agree. I just, my thing is necessity for most people. I think the American dream now isn't, owning a home with a white picket fence. It's getting out of debt. It's not having to borrow to make ends meet. One of our phrases is, the average person doesn't live beyond their means. They're denied the means to live. And in this sense, I think we're getting into a point where there's going to be a battle over deficits. Again, now that there's going to be a Democrat in the White House, Republicans are going to come out against deficits in government spending. And, I think we need to push back on that and say the problem is not, deficits. It's always deficit spending to what end? Are we deficit spending in ways that make us all richer than in, infrastructure, schools, healthcare, all of these things that we need as a society? Or are we deficit spending in ways that just increase inequality and perpetuate problems, and ultimately still leaves people living under conditions of austerity? So, we have to, I think, part of, if we're going to address the debt crisis, we have to address the problem of wealth inequality, the concentration of wealth, so that communities and people have the money they need. We see, municipal debt crises happening, because communities don't tax wealthy residents as much as they could, and instead borrow from them. And those bonds, people are not entitled to interest from bonds. That's a privilege. That's not, we should be funding social services through taxation. So I think that ultimately, to me, it comes back down to the problem that we just have enormous economic inequality that we have to deal with. Otherwise, there will be more and more and more debt.
Thank you. I wanted to ask you also, weaving in question from the Q&A about this last point that Astra made. Inequality of income or wealth, of opportunity, as the deep driver of the increase in indebtedness that we've seen in recent decades, and sort of as the driving force also behind maybe the education debt, the healthcare debt. Any idea? Would you agree? And then if that's the deeper cause, why don't we start addressing those deeper causes and treat and debt is if you will, just the symptom and not the cause where we should have the policy discussion about?
Yeah, I think there is an unambiguous correlation between rising debt and rising inequality. If you take Piketty's book, for example, and you layer on top of it periods when inequality is risen, they map pretty closely. And frankly, rising debt is a phenomenon that's not just since World War II. Rising debt's a phenomenon that goes back as far as time itself goes back. And the only gigantic corrective that occurred in U.S. Financial history was the Great Depression, with a reset button, both on debt and also on equality. So, it's. I think you've hit the nail on the head with your question, Moritz. We need to examine the factors that would bring more income and more opportunity to those who are increasingly disadvantaged. It's part and parcel of the solution. You never really solve it, you mitigate it, because debt growth's built into the system, but the slope of that debt growth is something that you can impact through policy. Absolutely.
I think we really have to think about the structural factors behind inequality too. So yes, inequality has been going on for a long time. It is driven by structural forces, and one of the key forces there is the skill bias technological change. That is the symptom to that, right? But not the cause. Yes, people maybe go and do borrowing and increase debt by seeing that, but without solving the key thing behind inequality, we wouldn't be solving that. Yes, we can do regulation and we can try to put that, debt under limit, but people respond to incentives, right? The incentive is going to be there again to borrow, especially combined with low interest rates. So I think the skill bias technical change is very important. And to me, the only solution to this is education. We have to fix education. If you look at the high school curriculum, this is like so old right now that it's just beyond keeping up with the modern days. And if you look at the research on this, the huge pickup in the inequality after like 80s, both in the US and European countries, it really goes with the technological progress. And it's just, if we don't adapt our education policy to this type of technological changes, it's very hard to deal with the income inequality, right? There's going to be higher incomes for better educated. And then, of course, accumulating over time, that's going to, lead to wealth inequality and all that. But of course, you start with income inequality. So these are very tough issues, tough questions, because they need structural reforms, structural changes to policies, and they won't be fixed with quick fixes, with short-term policies.
I do think, though, it's not just a symptom, because debt does exacerbate inequality. What we see is, especially when we take a racial analysis, the panel on, I think, the racial dimensions of debt was great. There's a phenomenon of predatory inclusion where people, especially populations that lack intergenerational family wealth, who suffer from wage disparities, take on debt just to get their foot in the door at a job, right? You go to college so that you can compete with a white candidate who lacks a college degree. So you're sort of forced into debt to just try to even the playing field, and then that debt spirals because that's the way interest works. So there again, lots of evidence that Black graduates, even if they graduate with comparable levels of debt to white graduates, actually, their debt explodes over the next 5 to 10 years. So I think it definitely becomes, there's a feedback loop, and it makes a bad situation worse in ways we have to pay attention to.
For sure. For sure, there's an accelerated effect. I fully agree with the feedback loop, but we have to go to the root cause. If we don't give the people the right skills, there's no way to really even make a dent to the inequality problem. Yeah.
Fantastic. So we actually will come to the end of this debt talk very soon. I want to ask you one last question, and from the Q&A from Kenan Amour, who says, What do you do with the argument that by forgiving debt now, you implicitly punish all those who've worked hard to repay their debts? I'm sure you have come across this argument before, and whoever wants to take a first step, how do we think about the equality and justice in that dimension as well?
You hear that loud and clear when you go out. I've done this. I've gone across the country and visited with, average families on this very issue, and you hear it loud and clear. At the same time, you hear all the pain associated with high debt. You hear someone who has worked hard to pay down their student loan or their mortgage or whatever it was, feeling resentful or wistful if someone gets that wiped out who wasn't as diligent as they were. And that's this issue of fairness that I mentioned, that you put in a component such as work in the, volunteer work in the nonprofit sector as a way to add a requirement to debt forgiveness that creates at least some component of fairness.
Yeah, I want to add, when we think about adding the work requirement for student debtors, I just want to say we should also add conditions when we, stabilize the corporate debt market and make sure they keep jobs, that they are environmentally friendly, just the what kind of debtors need to be held to moral account, I think is important. But yeah, we hear this all the time.
Clearly, Astra needs a cabinet position in the Biden administration. She could take care of all this pretty quickly. So.
So yes, I think one thing about the fairness, I mean, I hear this all the time too, and that duality, right, of the suffering, but also like the hold on. So I paid off my student debt, and I don't want anyone else to have to do that. So I think there's lots of people who think that. I think the historical dimension is important, saying it costs a lot more. So I'm just talking about student debt. It costs a lot more to go to college today than it did a generation ago. Right. So you might have been able to pay back your student loans pretty easily, but times have changed. So I think there should be some public education around it and around racial disparities and things like that. And I think there's the moral retort, which, is very, it's sort of social media and Facebook. Do we not give, COVID vaccine to people in the future because it would be unfair to all of those people who got sick and died of COVID? I mean, no, there's something like we try to improve the conditions for those who come after us. We try to make the world better for future generations. But yes, I think fairness is a key component, but we need to battle over the meaning of that word.
Sebnem, if you feel free to jump in, otherwise.
Yeah, so no, I agree with Richard and Astra. Although, this is an area I think where numbers are going to matter a lot. But I think, battling over what fairness means is going to come down to numbers, right? I mean, who is paying for it? What are the losses? Who is losing? And then, so which again goes to due diligence work. I mean, we have to do a lot of work on this.
Great. Thank you. Thank you so much to all of you, Astra, Sebnem, Richard, for this lively and very interesting, entertaining panel. I had a lot of fun and learned a lot, so thank you so much. As a reminder for everyone, and thanks also for all the Q&A and all the questions. I couldn't bring in all of them, but keep them coming. As a reminder, our next episode of Debt Talks will be on Tuesday, December the 8th, again at 12 noon Eastern time, 6 p.m. European time, and we'll discuss developing country debt, what's next for developing country debt and debt relief after the recent policy, the debt moratorium. If you haven't already registered, you can find the link to the right of your screen or on the INET website, and please follow INET live at INET Economics to hear about new episodes and information as we develop our series on the future of work. So see you next time. Thank you so much. Bye-bye. Thanks, everyone.